Trouble's brewing. The shadow banking system's starting to show real signs of stress, hinting that a new crisis might be kicking off. We're seeing defaults rise, which isn't normal here. So let's dive into the shadow banking world and see how it impacts the real estate market and figure out if the global financial system's cracking. Things look darker than we first believed. Check this headline from Zero Hedge. Chinese developers using negative down payment methods. Now, I want to lead you to what's going on in the shadow banking system because the problem is actually started in China. And you may recall back to the global financial crisis. Remember the suspicious loans before the big financial meltdown? Those ninja loans where you didn't need a job or income, and you could still get a loan on a very expensive home. Now, I want you to see what's going on here in China because it's going to open the door to major problems that you're seeing in the shadow banking system. China's real estate agencies have been quietly resorting to some of the oldest tricks in the US housing bubble book, such as marketing home buying with zero down payment or negative down payment. So consumers not only don't need to pay for down payment, but also can obtain funds for future renovation, according to media reports. Well, of course, we know going back to the financial crisis, anytime you're pumping prices up, they're going to do it because the market is already overinflated. They've got inventory they need to unload. They know they're getting down to marginal buyers, people who shouldn't be buying homes at all. But when you offer them no money down deals, or in fact, hey, we'll give you some money back, you can go buy a new home theater, that car, do some renovations, put landscaping in. You know that you're getting near the peak of the market. We know we're not far from seeing the bubble burst. And in China, as we've talked about in the past, the real estate market there is super sketchy and could take down not just their financial system, but the entire world.
The country is facing a financial meltdown. Every week, there is a new headline about its impediment.
Of course, we know here in the US, a lot of loans are being originated out of the shadow banking system. So whatever starts to go wrong here is a leading indicator of what's to come in the rest of the system. And with the US seeing problems here, and with this explosion of China, with them seeing issues, you can only see that this is quickly going to become a global issue. Now, China's shadow banking system is significant, with estimates putting it near $3 trillion. And this is predominantly rooted in China's vast real estate industry. This sector came into the limelight recently with the fall of Evergrande. Evergrande was one of the country's largest real estate developers. Their failure sent ripples across the global financial landscape, especially as many developers depended on them financially.
2021 was when we saw the company default on its debts, sending shockwaves across the global financial system and in fact triggering a string of defaults across other builders who were either owed money from Evergrande or were expecting Evergrande to complete some contracts for them. Since 2021, we've seen about 40%, or the companies that make up about 40% of China's housing sector default.
Evergrande's troubles began in 2021 when they devalued their bond payments. The magnitude of their debt is staggering. $300 billion, which is 2% of China's entire GDP. This situation has raised eyebrows internationally, as Evergrande has filed for Chapter 15 bankruptcy protection to shield its global assets.
Currently, as we understand it, Evergrande has about $300 billion in debt. It's lost about $80 billion in the last 2 years, and in fact has even been in a trading halt its shares since last year.
But why does this matter to the world? Well, the global economy stands at $105 trillion, and China contributes to $20 trillion of that. An economic stumble in China inevitably impacts other major economies, especially the United States. Recent stock market fluctuations and Bitcoin's drop can be linked in part to China's economic woes. Adding to the concerns that another Chinese developer, Country Garden, which is even larger than Evergrande, is also showing signs of financial distress.
How in scale and importance regarding Country Garden compare with that one? Bigger, worse, more worrisome, less, what?
Is 4 times as large as Evergrande. As a matter of fact, Country Garden, until I think probably the last week, was the #1 largest private real estate developer in China. Now it's #5.
This crisis extended its tentacles into China's shadow banking system. Shadow banking is essentially a segment of the financial system that functions outside of regular banking regulations. So think of it as a vast, unofficial marketplace where the rules just aren't that strict. In 2019, reports suggest that global worth of shadow banking exceeded $50 trillion. The importance of shadow banking can't be understated, especially in China, where it's largely intertwined with real estate. The defaults from developers like Evergrande affect the shadow banking sector, causing concerns about a cascading financial crisis.
Do we have a handle? I mean, if we extend China's problems beyond property and we start thinking about the shadow banking system there, how does that impact the economy overall?
And in the US, there have been economic ripples. Market dips or potential banking sector downgrades are indicators of broader impact. As a precaution, some individuals are safeguarding their assets, ensuring their bank accounts are insured, and diversifying their investments. So while the Evergrande crisis originated in China, its shockwaves are being felt globally. It's a situation warrants in close observation by both financial experts and policymakers alike. So the issues we're seeing in China's shadow banking system are getting out of control. If the government doesn't step in, and if central banks don't step in and put a wall around this thing, and at some point it'll get too big for them to stop, it's going to spread like wildfire across the global financial system. And with the US banking system having problems as it is, it's only going to get a whole lot worse, super fast. And it's already starting. And speaking of the government stepping in, China's stimulus rally lasts just 10 minutes, showing trader gloom. A short-lived rally in Chinese stocks after Beijing's latest attempt to shore up growth is underscoring the depth of investor pessimism towards the world's second largest economy. The CSI 300 index reversed losses to climb as much as 0.3% after the official, and I hope I'm pronouncing this right, Xinhua news agency reported that authorities will further ease mortgage policies to halt a slump in the residential property market. The benchmark started falling again in about 10 minutes, sliding to a fresh new low before ending on Friday, down 0.4%. And look at this. The lack of response to the gloom that has gripped China's equity market and shows once again that policymakers' efforts to revive investor confidence are falling short. Down about 10%. An index of Chinese shares listed in Hong Kong is the world's worst performer this month with more than 90 equity gauges tracked by Bloomberg. And take a look, overseas funds have been selling onshore stocks at a record pace. I've warned that China's situation is worsening. It's not just the locals who want out, they're eager to move their money too. Wealthy individuals are desperate to safeguard their assets. Meanwhile, outside investors are thinking, maybe it's time to withdraw our funds. And here, China's deflation could spill over into a global concern. I think they have a typo here because it's not could, it's already happening. Persistent deflation in China will likely spill over into developed markets, as a weaker yuan and elevated inventory to sales ratio lower costs of Chinese goods abroad. Well, by golly, I could have told you that. So what's happening here is that Chinese producer prices and the lowering of said prices are just spilling out into global markets. So it's not that it could happen, it's already happening. Prices are deflating from where they were a year ago and pushed out to consumers all across the world at a time when central bankers have a hard time believing that inflation is coming down real fast. And here you can see the consumer price index shown in blue against the producer price index for industrial activities in China, that's shown in red. And you can see where, of course, the PPI in China goes, consumer prices eventually follow. You can see that producer prices in China are indeed down substantially from last year, and it's acting like a rope lassoing those consumer prices down. According to the U.S. Census Bureau as of June, prices of goods imported from China are down 3% on average versus last year, while producer prices of consumer goods in China are down 5% in dollar terms. But make sure you don't tell Big Daddy Powell about this here. He has a fetish for those high interest rates. Importantly, these declines are being passed on to U.S. consumers. July marked the first time since the early days of the pandemic that the U.S. consumer goods prices decline on a 3-month annualized basis. And sure as hell, you can see that all this comes full circle. We look at import price end use of all commodities across the world. That's shown in red against the consumer price index in blue. Look at this very tight relationship here. And you can see that, of course, import prices lead consumer prices. And that would make sense because it gets on the shelf before you and I have a chance to buy it. And of course, there's a lag before it gets on the shelf and sold. And then it counts as a consumer price index. But here you can see this beautiful relationship suggesting that indeed the consumer price index in the months to come is likely to go down, only proving the fact that central bankers are probably a bit loony. Powell said the Fed will proceed carefully, but leaves door open to more rate hikes. Yeah, what proceeding carefully does mean is that he's not entirely sure how close to peak rates they are. But as we know, he was a little bit gun-ho for rate hikes before. But all he needs to know is that when consumers just don't have that much money to spend, demand goes down. Normally, Americans buy things on credit with money they don't have, And when that doesn't happen because banks don't want to lend to them, then, well, abracadabra, demand goes down and inflation soon follows. We can see here the net percentage of domestic goods tightening lending standards for commercial industrial loans to firms of all sizes. And that's against the consumer price index shown in red. And what do we know? When banks tighten lender standards, and eventually with a lag because there's less money created, causes a problem. Consumer price index comes down, and it came down during the global financial crisis, and it's coming down now, and yet the Fed just doesn't want to believe it. We see the current stance of policy as restrictive, putting less downward pressure on economic activity, hiring, and inflation. But we cannot identify with any certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy constraint. It's almost as if they have no clue about how the system works at all and what's causing the slowdown. And that is indeed the inverted yield curve. We can see here in red the 10-year and the 2-year. Notably, the 2-year very sensitive to the federal funds rate against the 10-year, which is more sensitive to economic and inflation expectations. So the Fed is artificially inverting the curve by jacking up interest rates and tightening financial conditions. As you can see, when banks can't lend money, they tighten financial conditions. When they tighten financial conditions, borrowers can't get as much money, less money is created in the system. And eventually we actually have an all blown out recession or a financial crisis that we now know will happen when indeed all the pandemic money is just gone. And that's estimated to end at the end of third quarter, so watch out, my friends. The fourth quarter is going to be like hell on earth. And with that said, if you like my vids, and I'm sure you do because I'm a likable guy, be sure to hit that like button. And comment below, I'll send you a pic of a cute monkey or something. Subscribe to my channel and check out some of my other vids here.